Hello everyone, thanks for checking out my video. For a moment, some investors thought that the stock market rally was over, but last week it reminded us that this bull market is still very much intact. All three US major indexes posted their first weekly gain of 2025, with the S&P 500 clocking its best weekly performance since the week of the US presidential election in November last year. All of these gains were likely the aftermath of a back-to-back reports that showed inflationary pressures are softening. Meanwhile, Bitcoin is back over 100,000 again. It seems like everyone's buying, everyone is partying, everyone's anticipating Trump's first week back in the White House. But with all that said, Trump is still a wildcard after all, so how should investors prepare for Trump 2.0? Let's dive in a little bit more in this video. As always, do watch throughout the video, okay? Alright, the US stock market closed their best week in 2 months with a solid rally last Friday. The latest surge in the market was driven by the so-called Magnificent Seven. What's new, right? Notably, Nvidia and Tesla popped more than 3% on Friday, while Amazon was up around 2.4%. The market has turned upbeat as investors celebrated positive soft inflation data and good earnings from big US banks. Here's a quick breakdown. The core consumer price index rose less than expected year on year, and the producer price index also had a smaller than expected increase for December. As a result, the 10-year Treasury yield pulled back sharply from 4.8% to about 4.6% as expectations for multiple rate cuts this year rose once again. In addition, strong earnings from major US banks also boosted stocks last week. Shares of Goldman Sachs Citigroup jumped about 12% for the week, Wells Fargo popped close to 11%, while JP Morgan Chase gained roughly 8.5% in that period. Overall, it was a strong week with optimism over the health of the US economy and path of interest rates as investors brace for a series of policy changes under the incoming Trump administration. And that brings me to the next segment, market outlook for the new week ahead. As mentioned, Donald Trump is set to return as the President of the United States for the second time on 20th January, Monday. In case you weren't aware, stocks rallied right after his November electoral victory as investors bet on deregulation and lower taxes. The market then faded a little bit, but it seems like the enthusiasm of having Trump back in office has been reignited. Whichever the case, the movement of the stock market between early November and last week simply shows that the market can be very volatile as the whole world anticipates and digests the policy changes that Trump could make. This volatility will likely stick around this coming week. Meanwhile, a gentle reminder that the stock market is closed on Monday for a public holiday. The Wall Street will only kickstart a whole new Trump 2.0 era on Tuesday. On the earnings front, it will start picking up with a few mega-cap companies reporting this week, such as Netflix, Johnson & Johnson, and American Express. A few major US airlines are also on the deck. In terms of economic data front, nothing too significant this week. Some investors may pay attention to Wednesday US leading economic indicators and maybe the initial jobless claims on Thursday. But I think what's gonna move the market this coming week will likely be Trump's speech on Monday. Let's now move over to the technical analysis section. For SPY, if you could recall, my last video highlighted one key level to watch, and that is 581. In essence, if it breaks, it's bearish. If it holds, it's bullish. Now check out the chart. This level was tested twice last week, and each time it held its ground. And the next thing we knew, the market rallied with 2 gap ups. So for this week, watch this 581 level again, just to show you how important this level is. Basically, SPY has tested this level 4 times since we had that post-election gap up. But somehow the bears had never succeeded in bringing SPY below this level, despite a few false breakdowns. Therefore, I would only say SPY is bearish if this level breaks. On the other hand, in terms of the upside, watch for 597, or maybe give and take a little bit. Let's stretch it to 600 where the psychological level is. As you can see, this 597 to 600 zone has proven to be an area of resistance, as SPY tested it for about 3 to 4 times recently as well. The last time when bulls brought SPY above this area, it went on to create a new all-time high. So if Trump 2.0 brings excitement to the market this week, and if SPY closes above 600, I would expect it to continue to move towards the record high level. And that level is 607. In fact, above 600, I don't think you would want to short the market. Not financial advice, okay? So yeah, in summary, two key levels or areas to watch this week: 581 and the 597 to 600 area. Anything between this range is what we call a market consolidation or sideways movement. Moving over to Apple's chart. Among the stocks that I cover, Apple looks the most bearish at the moment, as the share price was affected by the news of poor iPhone sales in China. As you can see, it is stuck in this tight downtrend channel. More importantly, it has lost the key and strong support zone of 235 to 237 that I mentioned in my last video. I specifically shared that if Apple starts breaking below this area, we could touch 220's range. And that was what exactly happened last week. To make things worse, Apple tried to reclaim this area throughout the week but failed to do so. The interesting thing is that this bearish sign somehow make the bullish thesis straightforward. Basically, for Apple to regain its bullish momentum, it needs to do the opposite of what I have just shared. In other words, Apple needs to break out of and go above this downtrend channel. Not only that, it has to climb above the key support area of 235 to 237, which unfortunately has now turned into a strong resistance zone. But here's a small little saving grace: there is a potential bullish divergence on the RSI. In addition, the RSI is floating at the oversold area, so there could be a short-term technical bounce or sideways movement. However, this doesn't mean anything because it could be a case of a dead cat bounce before another dump. So for bullish confirmation, it needs to do what I have shared earlier: go above 237 at least, or better still, go above 240 where the 50 moving average and the 50 Fibonacci level are. If Apple doesn't do that, it may just continue to be trapped in this downtrend channel, and the next potential reversal is at the 200 moving average level, around 217. That's actually quite a distance from the current price. All in all, be very careful if you want to take on short-term bullish positions in Apple at the moment. Let's now have a look at Tesla's chart, which looks a little bullish right now based on a few signals and movements. First of all, this 38.2 Fibonacci retracement level at 383 seems to offer a decent support, as Tesla tested this level for the last 2 weeks and the bulls held it well. Secondly, the share price broke out of this downtrend channel and have reclaimed the next Fibonacci level at 423. And thirdly, the MACD is on the verge of having a bullish cross, though it's not confirmed yet. So these were partly the reasons why I opened a bullish option trade last week. More on that later. Here's something very interesting, but before that, sorry, a quick one. If you would like to support this channel and at the same time looking to sign up for a new low-cost brokerage account, do consider the following: Longbridge and Tiger. I will get a referral fee if you sign up using my links and fulfill the following criteria shown on the screen. There are also some welcome rewards for new users, so please check out their websites. All said, please do your own research about them before signing up. Alright, back to business. Here's the interesting thing that I spotted. When I zoom out of the chart, this looks like a gigantic bull flag to me. But please take this with a pinch of salt first, because this isn't really the best bull flag I have seen due to this small little period of consolidation and the extended blue flag. That being said, like I always shared, the market may not give you a textbook version kind of pattern. So personally, I will be watching this potential bull flag very closely, because if this pattern ever materializes this year, I'm not kidding you, the upside is very massive. When I say massive, I mean 600 at least. That's a 40% upside from the current price point. Anyway, since it took from October to January for this bull flag to form, any breakout, if it happens, will likely take a few months to materialize as well. Let's see where Tesla stands come April or May, about 3 to 4 months from now. Why I find this interesting is because, just to add on to the earlier bull flag, even if I zoom in the chart, we still have this potential mini bull flag pattern which took 1 month to form. If this plays out, the upside is slightly lesser, but I would say about 560s range at least. That's still a 30% upside. Okay, just to reiterate myself, take these 2 bull flags with a pinch of salt, because if Tesla's upcoming earnings fail to impress investors, both bull flags could be invalidated, and the downside could be equally massive. In terms of the bearish thesis, watch that strong support at 383. As shared earlier, the bears had difficulty breaking below this 38.2 Fibonacci level. But what makes this 383 level even more important now is because that's where the current 50 moving average and the tip of the downtrend channel are. If Tesla starts closing below this level for a few days, it could continue to slide towards 350s range. Okay, jumping over to Google's chart. Similar to last week, Google is still in a consolidation stage as it continued to move between 187 and 201. If all is well and if this consolidation phase is still intact, then Google will likely test the top end of this consolidation zone at around 200. At this 200 or 201 level, that's when things will get a bit more interesting. As you can see, Google had only managed to kiss that 201 level during intraday on previous 2 occasions. So if Google goes to this level again, bulls would want the share price to close above it. When that happens, expect a breakout in the share price. One potential positive news is that the MACD is about to curl up, but take note of the word potential. So watch this MACD closely this week. If it has a bullish cross and the rise in share price towards 200 comes with decent volume, we could see another all-time high. But on the other hand, if Google gets rejected again at this 200 and 201 level, then we could potentially have a bearish triple top pattern forming. From here, Google would likely head back to 192 at least. However, so long as it doesn't drop below 187 where the bottom of the consolidation zone is, it is all good. I will be on my toes if it breaks below 187 because that's when the 50 moving average and the huge gap could be the best target. And that could be an area for me to step in to either trade something or snap up some Google shares. Let's see. Moving over to Meta. If you are trading Meta this week, you might want to hold your horses first because I think in the short term, the share price will be driven by the news on TikTok. So there could be knee-jerk reactions in the share price or intraday violent movements. Anyway, though Meta had hit all-time high at 638, there seems to be an invisible resistance at around 632. Meta went near and even went above this level on a few occasions but couldn't seem to close above it. Therefore, if Meta can start closing above it, I would think it's almost certain that it will take out the recent all-time high of 638 and recreate a new record high. On the other hand, another rejection at 632 will probably see Meta sliding towards low 600s or perhaps even 580s range again. These are where the 2 Fibonacci retracement levels are together with the 50 moving average. Okay, to be honest with you, Meta could chop around this 580s to low 600s range all at once. To me, that's called consolidation and nothing to be worried or excited about. But if it falls below 583, then yes, I will be on alert. Below 583, in a blink of an eye, Meta could be sitting at 560s range again. Okay, let's move on to Microsoft. Microsoft's chart has more red candles than green ones in the last 1 month. 14 red candles out of 20 to be exact. That's 70%. But here are a few good news for the bulls. First of all, Microsoft had broke above the blue dotted downtrend line. Secondly, it also went above the green dotted uptrend line. Thirdly, it reclaimed 4 key levels in just 1 week. The 61.8 Fibonacci level, the 50, 100 and 200 moving averages. Last of all, though it's not confirmed yet, but the MACD is close to having a bullish cross. If we have a bullish cross this week, I would expect Microsoft to fill the gap between 435 and 436 and perhaps even close above 436. From there, the final hurdle would be to close above 444 where the next Fibonacci level is. If we ever get there within these 2 weeks, something really positive must be happening for the stock, and I would think the bullish momentum will likely bring Microsoft back into the 450s range. For such big movement, the only possible catalyst is their earnings on the 29th January. However, if the earnings disappoint, or if somehow the market decides to dump this week for whichever reasons, could be Trump 2.0 or another round of yen carry trade, pay very special attention to 424. That level is where the critical 61.8 Fibonacci level, the 200 moving average and the 100 moving average are. If this level doesn't hold, I see a high probability for Microsoft to drop below 415 again. Okay, last but definitely not the least, Nvidia. Well, Nvidia looks slightly bullish to me right now for 3 reasons. First, it went back into the red downtrend channel last week, but only for 2 days, because right after that the share price rebounded and went above the downtrend channel again. Secondly, the share price had been creating higher lows last week from Monday to Friday. Thirdly, it has reclaimed the important 61.8 Fibonacci level at around 137. And I could potentially throw in one more good news here, and that is the MACD is about to have a bullish cross. By the way, sidetrack a bit, I find it quite interesting how many of these stocks have their MACD set up so nicely into Trump 2.0. Is it a trap? We will see on Tuesday and Wednesday. So if Nvidia continues to hold at 137 level and with MACD confirming its bullish cross, that's pretty bullish. Let me tell you what is even more bullish, which is to close above 140. 140 is a double resistance level where the 50 moving average and the 50% Fibonacci level converge. Therefore, if Nvidia can close above 140, I personally think the probability of Nvidia seeing 150's range is pretty high, could be this or next week. But with Trump 2.0, we must be prepared for the worst. So for the bearish thesis, to be honest, so long as Nvidia stays out of that downtrend channel, nothing is too bearish yet. It can lose that 61.8 Fibonacci level or even go below the 100 moving average at 133, that's fine. But once Nvidia falls back into that downtrend channel and don't get out quickly just like last week, I believe we could touch the 200 moving average in the near term. Okay, let's now move over to the options trading section. 3 trades to update this week. The first one is this new cash secure put on Tesla that was sold on 16 January last Thursday. The strike price is $300 and the contract will expire on 28 February. This is a momentum play. Let me explain. You know, a lot of times people love to ask this question: will the market go up or down after the CPI data is released? Or how will the market move after a big event such as earnings day, jobs report, election, the list goes on. And I always love to reply this: let the market makers go first, and then we follow shortly after. In other words, there is no need to predict the direction. Wait for the direction. So in this case, after PPI and CPI were released last Tuesday and Wednesday respectively, the market decided to go up, and so I followed the uptrend. To add on, during those 2 to 3 days, the market also received positive news from major banks in terms of their quarterly earnings. As a result, the entire stock market rallied as all 3 major indexes recovered losses and posted overall gains since the start of 2025. Well, with so many positive news on the card, how would I dare to go against the trend? Therefore, I decided to tag along the market makers and the bullish wave by stepping in on Thursday to sell a put contract, which is a bullish move. Anyway, in just 1 day, this trade is currently up about 23%. That said, I remain wary of Tesla's earnings day. So closer to the date, I will see how's the trend for Tesla's share price, and then I will decide whether if I should take profits by closing my position earlier. The next trade to update is this cash secure put on Tesla that expired last Friday 17 January. The contract was sold on 6 December with a strike price of $295. A quick recap: towards the end of last year, Tesla's bullish momentum was really strong. It was in a melt-up situation as it rallied from $212 to $489, which represents a 130% pop. And so I decided to ride the momentum. In fact, I shared this trade transparently in one of my previous videos, which I have linked it at the top. In that video, I mentioned that Tesla could fly, and boy, it really did. Anyway, since I sold that contract, Tesla went on to rally further, and my 295 strike price was never in danger of getting breached. Okay, I think by now you should know what I am going to say next. The contract expired worthless last Friday, and I got to keep the full premium of 330 without having to close the position. Alright, the last trade to update is this cash secure put on Nvidia, which expired last Friday as well. The contract was sold on 13 December with a strike price of 115. The reason for selling this put contract was because I expected a small bounce or sideways movement in the share price for the near term. Basically, during that period, Nvidia has already declined quite a fair bit, from around 153 to around 134, a 12% decline. More importantly, the RSI was approaching oversold area. Therefore, I anticipated a short-term technical rebound. And so, Nvidia went on to decline a little more before bouncing up from 127 to 150's range. Though it later dropped to the current 130's range, it did not go near to my 115 strike price at any point in time. So, the usual stuff, the contract expired worthless, and I kept the full premium of $130 without the need to take further action on the trade. Combining this trade with the earlier trade, the total profit is $460 less trading fees, and this translates to more than 600 Singapore dollars. Not too bad for side income for the month of January. Actually, I have 2 more contracts expiring in the next 2 weeks. Let's see if they can add on to this side income amount. If you wish to find out how I earned 15,000 of side income last year through options trading, feel free to check out this video. I have linked it at the top right hand corner. Okay, Trump 2.0, what to expect? First of all, let's break down what's happening in the market at the moment, then we try to anticipate what could be coming next. So, the latest better than expected economic data has resuscitated the bets on more interest rate cuts this year, as well as revived the Goldilocks narrative for the stock market. There is now this expectation that inflation is not as big as a problem that investors may have thought. Coupled with the oversold nature of the market and solid start to the corporate earnings season, investors took on the risk-on mode again, and that is why we are enjoying a nice bounce here in the stock market. Alright, so what can we expect from the market from this point? Let's discuss the very near term first, which is this coming week when Trump begins his second term as the US president. My personal take is, market will likely be very volatile this week. Watch the VIX index closely, which kind of represents the market volatility. Okay, in case viewers go thinking, every week is volatile, isn't it? Well, it's true in a way, so if I could paraphrase it, I would say last week and this coming week will be more volatile than what we have seen in the final 2 weeks of December. In fact, if you dive in deeper to see how the market moved last week, there were so many intraday huge V-shaped swings in both the indexes and individual stocks, and I expect that to happen again this week. Therefore, if one is unable to stomach such volatility, the best thing to do is to sit out the market this week. Let the market makers go first, then we follow shortly after. This is something that I have been sharing, and I also cover it in the earlier options trading section. Watch that portion if you happen to have skipped it. To add on, according to data from Charles Schwab, VIX options volume was above average last Thursday, and the most traded contract is the VIX at 18, expiring this Friday 22nd January. This kind of implies traders expect volatility to rebound this coming week. Alright, that was the expectation for this week. Looking at the bigger picture of Trump 2.0, there are still some uncertainties and fears about the future of inflation and interest rates. Reason being, Trump's policies such as additional tariffs could rekindle rising inflation pressures and slow the path of Fed rate cuts. Therefore, even with last week's better than expected inflation readings, some investors remain skeptical about the chances for more rate cuts this year. I mean, with the overall US economy in solid shape and inflation remains sticky, it's probably best for the Federal Reserve to be prudent and not be too aggressive in their rate cut campaign. But all in all, nobody truly knows how Trump's agenda will look like or what shape it will take. Therefore, in the weeks and even months ahead, I would expect Wall Street to continue to grapple with uncertainty about how Trump's trade and immigration policies will affect inflation. And with Donald Trump being a wild card and unpredictable, I am quite sure there will be moments where the market gets spooked by his words or policies. But despite all those questions, uncertainties and fears, I think we have started the year on a decent footing. And like I said at the very start of the video, the bull market is still very much intact, and at the moment I don't see it ending yet. And I have shared this since a few months ago. So far things still look pretty decent. And if there is any change to my position or views, I will update it here through my weekly videos. Meanwhile, if you have some time, you may consider checking out this video on my stock portfolio performance in 2024. But if you have no time, do at least spend half a second tapping on the like button. Thank you.